Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So as you know, I love dividend paying companies, and what I would like to do today is share with you guys 5 companies that have increased their dividend recently. And why do I actually like dividend paying companies or growth companies, dividend growth companies? Companies that are consistently increasing their dividends are generally seen as financially healthy and well managed. Their ability to grow profits translates into growing cash flow, which they can then share with their shareholders, which is absolutely amazing. Then you get that money. What do? You reinvest in the business. Then that means your one share has now become 1.5 shares. That then pays you more. So that half a share is now paying you more dividends, and that helps you with the compounding growth side of things. And when the markets are not doing well, so for example, in basically the lost decade, which basically was 10 years of the S&P 500 not doing anything at all, in those years, if you invested a dividend king or dividend aristocrats that have increased that dividend every single year, you still get paid, which means you can take the money if you wanted to. You could have reinvested it into the same business or different businesses to grow your portfolio if you like. So you didn't get any price appreciation in those lost decade, but you actually got the dividend increases, and you also got you reinvested that money into the business, which is absolutely amazing. So that's the reason why I like dividend paying companies, and that is a majority of the time it's a good sign these companies are paying this dividend and they are increasing that dividend. But now there are situations, and there's one example in this, I'm going to share with you guys today, where that is not a great thing. You've got some companies that increase the dividend every single year, but sometimes they use debt to increase the dividend rather than using their free cash flow. So I'm going to share that with you guys in today's video. If you haven't liked the video already, please do so. It definitely helps the channel. And if you can join us in the Patreon account, where you get access to a lot of things like the family portfolio, you get access to dividend trackers, the Sharia compliant investing ebook, as well as the Discord, please join us if you can. Okay. Now let's focus on today's video, just the latest increases. That's the bit that we're interested. But of course, we want to see if the company is profitable. If this dividend is actually supported. So we want to see if the revenue is growing. We want to see, if the EPS is growing. We want to see the profit margins, the return on equity, the return on invested capital. All of these things will help us understand if the if the management are really doing well, good job. We want to see free cash flow. We want to see a positive free cash flow, because that's the money the company uses to reinvest in the business, to buy back, buy their own shares, to pay as dividend, pay off any debt, acquire other businesses. They could do a lot with free cash flow. So companies with a negative free cash flow should be, you should stay away from them as much as you can. The total return, we want to see where the company has been in the last 10 years. Growth estimate next year and the growth estimate for the next 5 years is very important to see where the company is heading based on the estimations from these analysts. And we want to see Yahoo, Morningstar valuation as well. And what is the fair value for these companies? We want to see exactly, what this Morningstar is saying. And of course, sometimes add 10% give or take on top of that, just to be on the safe side if you like. Right, let's look at the first company. This company is Cummins. This is one of the oldest companies out there. Used to sell, diesel engines, but now they've diversified. They own all sorts of type of things, power generators, as well as, of course, engines. They produce their own engines with their, name on it, and they also basically create engines or manufacture engines for other businesses as well. The market cap is right now, it's about $40 billion, narrow economic mode, price right now $282 per share. So the bit that I'm interested is the dividend. So 2.6% of dividend yield. The payout ratio right now is only 35%, and the latest increase was 8%. The 5-year growth rate is 5%, which is 8%, which is really good. 18 years of increase in that dividend. So that means this company is a dividend, for 7 more years, it will become a dividend aristocrat. And in terms of the safety, we're looking about 98%, but you will get over $7 of every share of this company that you own. Revenue, the compounded annual growth rate the last 5 years, is about 7%. EPS about 26%. Profit margin about 6%. Return on equity 21%. Return on invested capital of 19%, which is really good. $2.5 billion of free cash flow. Total return the last 10 years 8%. Growth estimate next year 15%. 8% every year after that for the following 5 years. Expected to be around $246 per share, about 15% premium right now. Right now it's about $280 per share. So not too expensive, not too bad. The next company that we're looking at today is PPG. Again, this is one of the painting companies out there, very similar to Sherwin-Williams, about 30 billion market cap. Right now the price is about $126 per share, dividend yield of 2.2%, payout ratio 33%, and the latest increase is almost 5%, which is nice to see. 6% in the last 5 years. We normally look for about 7% or more, but 6% is fine. 52 years of increasing that dividend. What this means is this company is now a dividend king. The payout is $2.72, safety 83%, revenue basically about 4% in the last 5 years, which is not a lot. 14% in terms of EPS, which is better. Profit margin about 8%, return on equity about 18%, return on invested capital about 15% as well. Free cash flow right now $1.5 billion free cash flow, which is nice to see. So far we've got 2 positive free cash flow here. Total return in the last 10 years about 3%, which is not great. But next year they're expecting the earnings to grow about 10%, 9% after that, 7% premium. Right now $118 per share is where they think the price should be. 126 is where it's at. Now if we see a market dip in the next few weeks, maybe this will come back down to a price that is reasonable. Next one is UNP, or Union Pacific Corporation, which is another company that I own in my portfolio. 146 market cap. This is a railroad company. Right now the dividend yield is 2.2%, which is decent. 50% in terms of payout ratio. So this means it's quite low, so they can actually increase it. So what this means is they spending about 50% of their net income to pay us this dividend, which is absolutely fine. 3% was the latest increase, which is not great, but when you look at the last 5 years, it's double digits. 17 years of increase in it, $5.36 annual payout, which is really good. 88% when it comes to safety. Revenue in the last 5 years, we're looking at about 1%. Now, the expected double-digit growth in terms of EPS next year, which is really good. And because there is now new CEO, I think this is basically expected to, this is definitely going to change in the next few years. And this is where I was basically saying, so about 2% this year and then about 5%, 4%. So average is about 1% now, basically over the last 5 years. But I'm assuming hopefully the next few years that will basically slightly change. 7% in terms of EPS, profit margin 26%, return on equity 46%, 15% in terms of return on invested capital, 5% of $5 billion of free cash flow right now. Total return in the last 10 years 10%. Growth estimate next year 13%. Next, and then 15% after that. So which is really good. So I like the fact that there's this expectation for this company to actually grow double digits in the next couple of years, which is absolutely fine. Fairly valued right now $216 per share is where they think the price should be. Right now is $238. Apologies, I'm kind of struggling with my voice. I just came back from a holiday, so give me a few more days. InshaAllah, my voice will come back to normal. Albemarle Corporation is the next one, in terms of market cap about $10 billion. Now, I want to say one thing about this company, okay? And in terms of price-wise, there's a lot of things happening in the stock market right now. This company was trading about $325, I think, there you go, $325 per share in 2022. So about 2 years ago, less than 2 years ago, this company was over $325 per share. And right now we're looking about 92%. And when you $92 per share. Now, this is a warning to everyone out there that's now buying into the this AI and hype. I'm not saying Nvidia and companies like that will actually become this, but you have to be really careful. Do your research and please be careful, okay? And one of the reasons at the beginning of the video I said free cash flow is important is this. Look at this company now. They have a negative free cash flow, but they are paying dividends, which makes no sense. So I'll rather the company focus on, making sure that they get excellent free cash flow, get rid of this dividend and focus on this, okay? Because profitability and all of that is not there. The free cash flow is not there right now, but they are expected to grow this year about 161% and then negative 3% after that. 67% discounted right now, $275 per share. Now, it's a great company, but they really need to management now need to focus on building this free cash flow and making it the company a bit more profitable than, of course, paying a dividend. Because they're a dividend aristocrat, they actually want to keep that status, so they just paid 1%. So I just used this as an example to show you guys, look at the comparison between these two companies. And look at the next one. Okay, this is a company that sells uniforms. So if you ever need a uniform, you can go to this company and buy their product, right? 76 billion market cap. And look at this. Latest increase was 16%. And the payout ratio is only 34%. And now the dividend yield is quite low. However, look at this. Last 5 years, they grew about 21%. 42 years of increase in that dividend. So this is a true dividend aristocrat. 8 more years, they will become a dividend king. You get $6.24. Safety 97%, which is absolutely huge. Revenue growth in the last 5 years, the compounding every single year, you would have made about is gone up about 25%. EPS about 16%. Profit margin 16%. Return on equity 38%. And return on invested capital of 28%. Now, free cash flow $1.5 billion, and you would have made 28% every single year if you own this company for the last 10 years. So that's compound annual growth rate in terms of total return in the last 10 years. Now, they expected the earnings to grow about 10%, 13% after that every single year. So double digits for the next 5 years. But it is very, very expensive. For that reason, it is quite expensive. 45% up basically premium right now. $520 and right now is over 764 pounds or dollars. So it is expensive, but it's a solid business. This is the type of business you should be investing in when they are cheap, not right now. Okay. Finally, just to show you from a Sharia compliance side of things, there's nothing to worry about. You can pause the video and have a look at it. But like I said to you guys, always focus on high quality businesses that are increasing the revenue. The EPS and revenue is growing, free cash flows are growing, the returns look good in the next few years, and of course, buy them when they are cheap. Now, to quickly show you, Cummins used to be one of the undervalued companies I used to own back in the days. Right now, it seems to be overvalued. I am up about 30% this basically since the beginning, since I bought it, about $864 right now. The next one that I own is Union Pacific, and as you can see here, about 16% up or $685 per share. That basically I'm up right now. So both companies I was buying when they were actually undervalued. This one seems fairly valued right now, but I would not be adding to both of them anytime soon because I do own other companies that are undervalued at the moment. If you're enjoying this type of content, please join us at the Patreon account. It genuinely helps the channel. I genuinely appreciate every single one of you guys out there, either watching the videos, sharing with the family and friends, joining us at the Patreon account and so on. Have a wonderful, wonderful day. Assalamu Alaikum.